everybody. Luke Gromen, FFTT. Great to see everybody again on a Sunday night here. Thanks for joining us for another two things that grabbed my attention recently. I'm going to highlight the two things, and then I've got three questions here that I pulled off of our feed from you guys. Appreciate it. And we'll talk about those a bit, and then I'm going to jump off and catch the end of the game. So first off, S&P rallied more than 1.5% in March, while the Russell 2000 fell more than 2%. Over the past 2 years, this divergence only happened one other time, which was in March 2000. And this I retweeted today. It was via Troy Bombardia. I think a lot of times you can tease whatever you want to see out of certain statistics like this. The thing that really grabbed me about this and caught my attention was that it surprised me that sort of underneath the surface, with the headline S&P number and a lot of the excitement about one of the best quarters in 10 years in the S&P, I didn't realize that the Russell 2000 was down over 2%, and so that suggests maybe a little bit of reason for pause, but we'll watch that going forward. The flip side of that, though, is the second thing that grabbed our attention, which a couple people brought up and actually had it on the list to discuss anyway, but it looks like Asian data might be starting to turn off the lows at least. You saw China's ISM was the highest in 5 months, and emerging market Asian financial conditions are beginning to loosen somewhat. And so to me, that could ultimately be a trump card that could drive markets and higher, and also overshadow the prior technical factors. So it's something we're definitely going to be watching very closely to see if there's some kind of follow through in terms of some of these Asian data getting better, or if it's just a little bit of catch up in terms of or pause. So I had three questions I thought that I wanted to highlight. First off, from Michael, are various charts showing all-time high U.S. financial asset prices versus other markets telling us more about the dollar than anything else? It seems simple. Dollar liabilities cannot be met in real terms, but pretending they can be leads to some awesome assumptions. Hi, Michael. I think this is a great question, and the chart he showed in the feed for the Periscope here was, I believe, U.S. bond markets over commodities. U.S. bonds are at all-time highs or 100-year highs relative to commodities, and a lot of these charts are relative to commodities. And I think there's two things going on. I think the bottom line, I do think it's telling us a lot more about the dollar than anything else, but I think there's really two things. I think it's underappreciated the degree to which the U.S. dollar's hegemony, if you will, has been supported by the expansion of commodity derivatives in particular, and gold derivatives specifically, but then also expansion of cash-settled derivatives in treasury markets as well. And both of those things are very important. The point here is that as the dollar's monopoly in commodity markets starts to break down, you would expect to see commodity prices in dollars tank. You'd expect to see dollar asset prices relative to commodities go to 100-year highs. And we've been there, interestingly, since around 2013, 2014, when you saw the gold market break down with too much physical buying by China. And so I think, first off, that these charts showing U.S. financial assets at all-time highs relative to commodities, I think are actually a symptom of pressure on the dollar-centric system itself. And, mechanically, as you think about this, we'll just break it down very simply. Pretend you start selling more oil globally in yuan. Well, if that's the case, then all of a sudden there's more yuan out there. There's not a lot of instruments to soak up that yuan. And if you do that, then you're going to have more yuan, a little bit less dollars, and you should see the yuan fall against the dollar. Okay, well, if you now have contracts in dollars and the yuan falls against the dollar, through the oil link, the price of oil has to fall. And so we've been seeing that for the last couple years. You've been seeing, and so I think ultimately, mechanically, and symptomatically, the weak commodity markets are, I think, quite possibly, quite likely a symptom of the multilateral energy or multilateral commodity pricing slowly gaining traction. The other thing within this question I think is very interesting is on any number of levels. You're at this commodities relative to financial assets, when you look at different charts, you're back at levels where you have seen last time we were somewhere close was 1971 or 68. Before that, it was 33. These times when you've seen real major currency system changes. And so that, to me, I think is very important. Second question was from Doug. U.S. and the world cannot afford a recession. It's also been said by you that we needed huge risk of crisis to start QE again by the Fed. So I guess something has to give with this U.S.-China trade deal. Seems to me the deal has got to happen or things could get very bad. My thoughts. And the bottom line is, yeah, I think that's right. I think you do need to get a deal done. We've bought some time in terms of some of the central bank jawboning. To me, it's interesting the degree to which most analysts are completely ignoring the geopolitical and the trade side now. It's all about the Fed. It's all about new liquidity coming in. I get it. I thought it would come. I was a little early thinking it would come. I've been surprised by how the markets have reacted to it now that it has come. But that said, I think they are completely ignoring the reality on the trade side, which is it's still a matter of national security for China to move away from the dollar, to get yuan oil pricing. It's still a matter of national security for the U.S. not to grant it. You still have them at loggerheads over various aspects of this trade deal. So I still think the optimism over the trade deal is not well founded, and I continue to think that the bond market is completely mispriced for the very real odds that we don't get any real substantive deal. Now, one last thing I would say on the trade deal that I thought was extremely interesting from last week. Wall Street Journal had an article talking about how China and the U.S. are talking on cybersecurity. And I don't think that's a surprise to anybody. The thing that grabbed me, and to me was a little bit of an inside baseball read, was if you looked at the picture, it showed that it was Steve Mnuchin, Treasury Secretary, and his purview is the dollar. You had the governor of the People's Bank of China in this meeting, and then you had the Vice Premier of China, and then you had U.S. Trade Representative Lighthizer. So a picture of these four. Lighthizer dealt in the manufacturing sector. 4 weeks ago, he gave congressional testimony talking about the U.S. dollar's reserve status and how it can't lead to job losses. And then you've got Mnuchin, who's the Treasury Secretary, whose purview is the dollar. The chairman of the People's Bank of China and the vice premier talking about cybersecurity. Something doesn't add up. And my point is that I think at least some part of what is being called, quote unquote, a meeting on cybersecurity, I think they're talking about currency markets. Those are the people you would have where you'd be talking about currency markets. And if you were going to talk about currency markets, you sure as heck couldn't say you were talking about currency markets. You'd talk about something like cybersecurity or soybeans or something, right? So that is probably the thing that has me most interested when we talk about the dollar, when we talk about these trade deals. But the bottom line to me is that I think markets have gotten too euphoric about the liquidity, and they've completely sort of checked out on the still low odds of a trade deal. Unless that trade deal happens and like I said, I think takes the dollar down. Then I think markets make what they're doing in terms of equities rising the way they did in the first quarter makes perfect sense. Okay, last question here from Mark. Thanks, Luke. What do you think will happen first? Will the dollar break up or break down? Unless we get a trade deal, a comprehensive trade deal where the dollar is weakened notably, then I think the dollar breaks up first. I'm still skeptical that they will get a deal done for a number of reasons in any real manner. But that's the I think if you get a dollar deal or a deal with a with a comprehensive sort of part of that weakening the dollar, then I think everything we've seen year to date in markets by and large makes sense. But if we don't get that, and we don't get that soon, because this dollar liquidity issue is back to the forefront. If you look at Jeff Snyder's work from Alhambra, etc., it's back. So it's going to be important to watch going forward. I think it's over the next 3 months in this quarter the trade deal, news on the trade deal are going to once again come to the forefront, and I think bad news on that will be reflected, and I think good news on that front would be reflected as well. So it'll be an important thing to watch. So I'm going to jump at this point. So everybody, thank you very much again, as usual, for checking in, and look forward to catching up with you next Sunday night. Take care, everybody.